principles of accounting. Now, got to know what it is we want to do. Once I know that, I can start to put it together. Now, if it was straight line, as this one was, nice and easy, I can do it all in one column. Why can I do it all in one column? Because it was a straight line. And because it was straight line, the number at the bottom here will be the same. Well done. The same for every year. Easy. Now, for the exam, obviously it's not going to be that easy. I'm going to give you double declining balance, which means, you're going to have many more columns. Got no choice. Okay? When it's straight line, it's easy. Double declining balance, it's still easy. It's still easy, but I'm going to have to work in a column just for the depreciation. Okay? Now, I've got my sales, I've got my expenses, sales, expenses, minus my depreciation. I'm going to look at the cell in a moment. I'm going to look at the cell because whatever is going on in that cell has to handle that. Make it. Everyone with me? Let's not look at what's sitting in here just yet. For the exam, it's going to be equals D, and at this point, I don't need to type anymore. Double declining balance. What does it want? It wants the cost. Now, what's the cost? The cost is what? Okay, don't give me a number, give me words in accounting.
The initial value of
the initial cost of the plant and equipment plus, you know I'm not going to make it quite that easy, plus what?
All the costs to get it ready for
Good,
use.
good. So if I talk in the problem about here's the cost of the plant and equipment and here's the cost to get the site ready, that's part of the cost of the plant and equipment. It's got to be capitalized. Remember Enron? Maintaining the telegraph poles? I mean, now we can, I was about to say, feel sympathy for the Arthur Anderson people. I'm not sure they deserve sympathy. Well, they certainly didn't get it through the courts. But the repairs and maintenance of those telegraph poles, MCI WorldCom, with the approval of Arthur Anderson, did they treat that as repairs and maintenance, operations through to the income statement, or treated as capital up onto the balance sheet? Capital. They treated it as capital and it went up onto the balance sheet. Okay? And of course that's going to make your income statement look great. It's going to make your balance sheet look great. You've got all these assets now. And they didn't have them. Their income statement was worse and their balance sheet was worse. And when it finally got discovered, that's what brought both firms down. Okay, because it was huge, the loss. $11 billion, I think it was. Okay. So, obviously I'm going to give you a question where it'll tell you the cost of the plant and equipment, plus these other major costs to get the site ready. There won't be any doubt. The cost to get the site ready is part of the cost of the plant and equipment. In accounting, that's to be capitalized, treated as a fixed asset. So that will give me that dollar amount. We've we've got to tell you the salvage value. You know it won't be zero. We'll tell you the life, we'll give you the life, we'll tell you the life of the plant and equipment, and then which period are we doing the calculation for? The first year, second year, third year? Okay? And we don't need the factor. The factor deals with, do you want to switch over to straight line or not? And we won't do that, we'll just stick with double declining balance. Okay?
And that'll give you the
Easy.
depreciation?
Pardon?
That'll give you the depreciation?
It's going to give me the depreciation. Okay? So, I wanted to deal with that before we look at what's going on in here, because when we look at this is a multiple choice question in this chapter, so you may get this question, and it's probably the worst question in the chapter. Okay? Now, if we look at this formula, it's messy. Why is it messy? Well, forget the formula for a moment. We've got to know how to do makings. So let's look at this machine. It's considered 5-year property. So which of these two columns am I going to look at? I got to look at the 5-year property column. Which year am I in? Which year am I in? The year that I'm in will determine which percentage I'm going to go and retreat. So the first thing I had to do in this formula was to determine which year I'm in order to determine the vertical lookup. So I've got 2 vertical lookups in here, 2 vertical lookups. And when I highlight the formula, you can see the color being highlighted. So which of these 2 depreciation calculations do I want to use? Any questions? So what was messy is I needed 2 vertical lookups to go and find the correct depreciation amount, depending on whether it's 3-year or 5-year property. Now, once I get the depreciation, I can get my profit before tax. My profit before tax. Once I get the profit before tax, I get my, coming back over here, I get my tax. Then I get to my profit after tax. And then I'm back over here, add back my depreciation. So now I'm ready to do chapter 12. So chapter 12 didn't actually start until I got over here. This was just accrual accounting. Yes?
Are you gonna have us tax the gain on our salvage value then, or loss?
No. No, not on the exam. Good point, Will. I won't change it. And that's a very good point. Recapturing the tax. No, I didn't do that. Didn't even think of it, actually. Okay, so up until this point, all we're dealing with is financial accounting. Now we're dealing with what chapter 12 is all about. The cumulative cash flow, the present value of the cash flow. Why did I need these? Ignore the last column. Why did I need this column here? Cumulative cash flow. Why did I need that?
Present value payback?
The present value of the payback. Absolutely. Okay, so let's come over and look at the metrics being calculated. So my net present value, again, leaving the initial cash flow outside of the formula, outside, because we don't want to discount the initial cash flow. period of time for the cash flow. Discounting it, I have my net present value. Then the internal rate of return, nice and easy, the entire column. The entire column. Okay. And then the accumulation, straightforward. Let's come back over here. There is another built-in function in Excel. It is covered in the chapter, the modified internal rate of return. Okay? And here is the actual formula being used. And what are we passing it? What are we passing it? We're passing it, what's L21? L21 to L39, the cash flow stream, and we're passing it two more parameters. What's the first parameter that we're passing it? C27, and then we passed it C27 again. What is the modified internal rate of return? What is it?
Square root.
No. Explain it to me in English. Okay.
Just use the present value of it?
Stop. What's the problem with internal rate of return?
Size disparity, time disparity.
Pardon?
There's the size disparity, the time disparity between cash flows.
What's the problem with internal rate of return?
Doesn't interest rate.
Assumes that the cash flows are gonna be invested back at.
Internal rate of return has a built-in assumption. Net present value and internal rate of return are the two methods that appear in all textbooks for evaluating capital expenditure that recognizes discounting of cash flow. Everyone okay on that? Which one of these is superior? Wouldn't you think that one would be better than the other?
Net present value.
Then why do we have two? They're not the same. They've got elements in common, but they're not the same. Well, what is different? What is different? And is one of them better? Well, let's answer that last question first. Is one better? Yes, net present value. Well, what's wrong with internal rate of return? What is wrong with it? You need to know that. The internal rate of return assumes, as this gentleman said, that the cash flow that we're getting each year will be reinvested at 13%. That's the built-in assumption, that you will indeed reinvest it. Do firms reinvest the cash flow from their investment opportunities at the cost of capital? Do they? Well, let's deal with two situations, privately held and publicly held firms. Privately held firms, mom and dad.
No.
Mom and dad want to do what with the cash that they're earning?
Buy a car.
Spend it on personal matters. They want to take it out of the business and have fun with it. They don't reinvest it. Let's go to a publicly held firm.
Depends on the market.
They don't reinvest that.
Well, some of it gets reinvested, and some of it gets paid out as dividends, and increased salaries to managers for performing well. But the key point is, whether it's public or private, they do not reinvest 100% of this cash flow at the cost of capital. They don't do it. So, thank you, Microsoft. They came out with a new function a function that allows us to do what? To give it two interest rates. One interest rate, the first one, is the cost of capital. And the other interest rate is an interest rate that you could earn on the money if you reinvest it. Okay? Now, because the problem only gave you one interest rate, I did what? I had the same interest rate in each case. But if they had, in the problem, given me a statement that we can take this cash and invest it at 10%, 8%, then I could have given it 8%, 10%, that second interest rate. And then it would have given me a lower internal rate of return. Okay? A little more complex calculation. Now, it is covered in the book, modified internal rate of return. Excel has a function for us. Okay? Next thing, payback. I will go over it again, exactly the same payback that we did on the previous example. Present value, won't go over it again, same as what we did, but now using the present value of the cash flow. Okay? Here's where I wanted to get to, these two here. The book rate of return on the initial investment. And the book rate of return on the average investment. Now, the book rate of return on the initial investment is nice and easy. First of all, already answered it, we'll ask again. All of these metrics involve cash flow or accrual accounting. Wait, all of these metrics involve cash flow or accrual accounting. Well, badly worded question. In capital expenditure, we're focusing on cash flow. And most of the metrics are indeed cash flow. But we're accountants, and accountants love accrual accounting. And you'll work for firms where, don't argue with the boss. We should focus on cash flow, but because of the chief accountant's fascination with accrual accounting, they like to do some metrics that involve accrual accounting. So we have two. We have one that's based on the initial investment and one that's based on the average investment. Well, if it's the first one, the initial investment, nice and easy. What was the initial investment? We're given the number and the average of the income divided by the initial investment. Nice and easy. Okay? But the next one is a little messy. Not messy because of that formula, messy because of this column right here. So, what's involved? Because it requires the average investment, we have to determine at the end of each year the book value of this piece of equipment. So we paid $530,000, and each year we're going to have to do what? Get to the book value. So what are we going to have to do? We're going to have to subtract the depreciation. Subtract the depreciation. Subtract the depreciation. So now, when performing this calculation, instead of just looking at 530,000, we're looking at the average of the book value. Average of the book value, average of the income. So we've got two metrics here that are accrual base. Okay? Now, we would prefer firms not use those two metrics, but they do. And that's why we have to cover it in the classroom. We would prefer firms do not use payback, but they do. That's why we're covering it in the classroom. What we want firms to use is net present value and internal rate of return. We should cover those two in the classroom. Students should know which one of these is superior. You should know that. You should know why internal rate of return is inferior. It's an inferior metric, not to all the others, but inferior when comparing it to the other major discounting calculation. Questions? Yes.
For the rest of those formulas where you just added the 38,965.
Yes.
Just because that's the remaining book value,
Right.
was there any special formula you put in there?
No, it's just the balance.
I mean,
We had no depreciation.
all right.
Now, probably what we'd do is just write it off.
Mhm.
But I'm following the formulas in Excel. If this was the real world, we would have written it off. We wouldn't be carrying that. It would be-
It's just what it does in ours,
Yeah.
of course.
Yeah,
It's just written off.
Yeah.
Wondering why.
oh, it is in yours, okay.
Yeah.
I must have altered this then with the shit. This is just the file I've opened up from previous semesters, and I must have made a change in here. Okay, to my formula. Your formula's right then.
Yeah.
Good. Okay, any questions, folks? Easy chapter, easy multiple choice questions. Next week, the next 2 weeks, chapters 14 and 15. If you would read it before you come to class, you'll be better off. Just know that 14 and 15 all around the world are considered two very difficult chapters. Okay? The problems for 14, remember there's no Excel, not this semester, it will be next semester, but chapter 14, the multiple choice problems, if you've understood the chapter, it's not too bad. I will emphasize the points in class, but if you'd read it before coming, that would be of great assistance. Chapter 15, read it, I'll emphasize it, it's still damn hard when you get home. Okay? But the only good thing is, you know you don't have just 15 on the exam. You get 1 or 2 questions on it. But chapter 15 is difficult. Now, I do go over the most difficult ones in class. Okay? So I'll see you next Monday.